Yeah, thank you, Ramu. Nothing much, and actually, all the documents are ready. Paperwork is ready. If you're ready, you can do the paperwork, and also the bank account information is also ready if you want to send the funds. We feel that this is going to be oversubscribed. Just to give you a small heads up. Thank you all very much. Now I invite Azar to take up the questions, and probably Shigeru to coordinate. Who he wants to pass on and all that. Go ahead, guys.
Thank you so much, Ramu. Thank you so much, Raman. Perfect, guys. So let me read off some questions here, and then I will facilitate to the team member that I see best fit to help answer it. And if I can answer it, I'll answer it right away as well. So let's get started. So the first question is from Brian Rocha. The question is, can you provide case studies or examples of previous similar investments by TeamVelu and ZT Corporate that achieved the projected returns? So I'll get started with the history of, in terms of similar returns in the past. So we've operated everything from sleep centers to imaging centers to surgery centers, hospitals, micro hospitals in the past. Apart from that, infusion clinics, infusion business, home health cares, hospices, all of these basically, whatever we had projected out, anywhere between 10 to 12%, depending on the business, in terms of cash flow, we have achieved. And then also on the sale, we've been able to achieve a profit for the investors as well. Just recently, early this year in March, we sold our large real estate portfolio. Investors netted about 35 plus million on that deal. The ROI was, very positive. And during the time of the holdings, they had gotten distributions, in some cases north of 30% annually, in some cases 12% annually. So it really depends on which real estate holding they were in. And then previously, last March, we did a $120 million leverage buyout transaction from our investors for our dealerships that we own and operate. And they basically, throughout the time that they were in the project, they were getting about a 8% annualized return. And then when we exited, they doubled their money. It was a 2.05x exit, and then overall in the deal they had made about 2.43x on the deal. So that was fun, returning that kind of money to the investors. And then one of the largest sales that we've had for investors ended up, actually, no one predicted it, but it just, investors ended up making a 9x return with the combination of distributions and also the exit. In that business, we had actually projected a 28% annual distribution when we started that business. The business did so well that not only were we able to reinvest a lot of the money in the business, but also achieve a 40% annualized return through dividends. And then on the sale, it was like a 5x return. So overall, it was like a 9x return. And then for a while, we operated fast food restaurants. One example is for Popeyes. We distributed out around 12%, and then we exited, and it was like a 30% exit. So it was like within 3.5 years, we did a 63% total return on top of people's principal. So here are some examples from our side. So I hope this helps, Brian. Ramu and Raman, would you like to add anything on here?
Absolutely. So the last investment we did for 25% was a secured debt note for construction of an affordable housing single-family neighborhood outside of Atlanta, Georgia. And that is because it's secured by debt, it's secured and guaranteed, backed by personal assets of the owner of the company, the two GPs, as well as their corporation entity. So that was the last deal we did that had similar returns.
Fantastic. Sounds good. So, Brian, hope that helps. And then I'll move on to the next question from Bharat. Why is ZT Corporate not financing the deal fully through a bank? Question mark. How many projects have gone full cycle? Question mark. So ZT Corporate does use bank financing. So essentially, we're raising about $75 million for this deal, and then approximately $75 million will be financed. I will actually now invite Mr. Babar Sheikh to help answer this question fully, because part of being in the M&A team, he is the one who's actually working with these banking relationships. So Babar, would you like to add to my answer?
Yes, absolutely. Sorry, trying to get my camera on. So we take a conservative view on our debt, just to ensure that all our businesses, operating businesses, are healthy. So when we acquire this business, we will use approximately half of the acquisition proceeds will be from our existing lending relationships. And the idea behind that has always been that we take a conservative view on our leverage, to make sure our business and operations are always healthy.
Fantastic. And I believe, Babar, we're using a consortium of banks, right? Or like a group of banks in order to do this deal. We're not using just one bank to do all 4 acquisitions, correct?
That's correct. We're using a group of banks that helps us spread out the risk a little bit. It also works great from a relationship perspective. So that's how we approach most of our deals.
Thank you so much, Babar. So, Bharat, I hope this helps answer your question. And then the next part of the question is, how many previous projects have gone full cycle? We've done, on the exit, more than 20 limited partnerships have gone through an exit for a liquidity of around 350 million. And Chihiro and Kevin, feel free to correct me if I'm wrong, but I believe that's the case for the last few exits that we have done.
No, yeah, you covered it, Ozer.
Perfect. And then the next question is from Brian Rocha. What regulatory or market challenges do you foresee? And how prepared is the team to handle these? Very good question, Brian. I will now ask Mr. Jason to help answer this question.
So I'm trying to get my video on, but here's what I'll tell you. Look, I think that there's a confusion in the market, right? There is not a challenge right now with this type of product. I mean, we are so focused on providing a small group of people this access to emergency care, right? And so our facilities generate our cohort from 6.8 to 7.1 miles around our facility. And so usually that number's in the range of 30 to 55,000 people. And I think that, what we have created is a new model for healthcare, right? And so as people start to expand out from big populous areas, they want to have the ability to have something close to home that is not going to be 45 minutes away, but rather 10 minutes away. And then when they get there, they don't want to have an experience that is, like a normal hospital where you go into the ER and you have to wait 2 hours, 2.5 hours. Rather, you come into our facilities, and our average wait time across 27 facilities right now is 16.7 minutes till you see a physician. And we're talking about a ER certified physician, that's been trained in this process. And so the throughput that our facilities provide is under 2 hours. And so when you start talking about the differences that you see between the two models, what you're really saying is, by the time you come through our facility, you could be at home watching reruns of something at home. And if you had gone to a hospital, you'd just then be seeing a doctor at that point 2 hours later. And so, what I think the opportunity here is to, once again, as I said earlier, is to really start to create this new model. I mean, this has been going on for 13 years, and it has truly started to accelerate throughout the U.S. right now. I mean, look, over the past 8 years, 2,873 small format healthcare facilities across rural areas. And when I say rural areas, I mean populations of under 60,000 or less have shut down because they were government subsidized. And so they were run as healthcare businesses subsidized by the government. We run them very differently. And so we run them in a very, business fashion that is focused on the patient delivery of care. And, and that is the difference, that is the thing that we offer that others can't. And so, I think that we are really positioned to continue to grow this business, but it's, it's something that others haven't seen before. And so that's why it's been so successful in the areas that we've, opened these facilities.
Fantastic. Thank you so much, Jason. So just for all the attendees and folks that'll watch it and, on the recording, Jason's experience, we're experienced in one state to do emergency rooms, which is Texas. Jason is experienced in 9 states. So, what he's saying, he understands exactly what the business needs or, what the industry needs as a whole from a patient standpoint. So his point is, if you do right by the patient, opportunity is there. In terms of regulatory challenges, we're positioned in a way that it actually saves insurance companies a lot of money. So rather than folks going to the hospital ER spending thousands of dollars, going to a freestanding emergency room can end up being cheaper for the patient and also the insurance company. The next question is from Larry Ho. Would this qualify as a qualified small business stock tax benefits? I wouldn't think so. Ramu or Babar or Chihiro, if you guys have any other answer, but this would not qualify. But you could definitely. We're not tax advisors, obviously, but if you want to discuss it with your CPA, definitely you can. But the first thought would be no.
I don't believe that it is, but the PPM is available on our portal. So if you register on our portal and you're known to us, you can get on there. You'll be able to download the PPM and share that with your tax advisor or CPA to get that answer. Unless Babar or Chihiro know of that specific incident. No.
No, not a tax expert, unfortunately.
Yeah. So guys,
Okay. That's
all the
it.
panelists, if you guys would come on the screen, go ahead and come on now, just so it'll speed things up. The next question is from Brian Rocha. I love this question, by the way. What is the exit strategy and what conditions need to be met for a successful liquidity event? I have a lot to say on this, but I will start off with Babar on this, and also Jason, because all of them have gone through multiple exits in their careers. So Babar, we'll start with you.
Perfect. So Brian, great question. I'll start by saying that we're very opportunistic about our exits. We're not really constrained by fund cycles or other sort of timing restrictions. So we'll always look for the right opportunity and sort of the right buyer. Where we'll see benefit, our exit, first of all, could take many forms. So it could be an outright sale if the timing of the offer and the strategy is right. It can also, take the form of recapitalization, where if the market conditions are good, and interest rate environment has changed, we can use, we can change the capital structure of the business, which is essentially using debt to, buy back some of the equity investments. That usually comes at a very good, attractive return. But the main benefit that you'll see on the exit here is that we're likely to exit as a portfolio of micro hospitals and ERs, 30 plus, versus just the 3 or 4 that we're acquiring as part of this acquisition, and that will result in a significant sort of multiple uplift, and that's sort of the value gain that we'll all see on the exit of this transaction. Azar, I'll turn it over to the rest of the team if there's more to add.
Fantastic. So, great answer, Babar. And then Jason's actually been part of. I don't want to steal his thunder, but I am going to steal it. To 4 exits within the same ER space. So, Jason, please chime in on your experience of exiting emergency rooms, and then I will go ahead and take it from there for general exits that we've done in the near past. But I'll only go as far as the last 6 years of all our exits that we've done.
Yeah, and look, I think that I've been very fortunate to be around, very smart people for a long time. But, here's the thing with healthcare, that is it's a timeless need, right? And so it's all about delivering the right product. It's all about quality and patient experience and patient engagement. And so when you start to deliver that kind of product, there are big businesses that come looking for you. I mean, if you look at, an HCA or, Dignity or something like that, that is expanding across the US, who are starting to develop insurance products, right? They're looking for staples in neighborhoods that they can go into that they know are quality. And so fortunately, in my exits, what I've been able to do is work with groups of people that know that, look, if we have a sense of urgency and have an expectation of excellence, and we work with the right people and then start to deliver the care that people deserve. I mean, we're not doing anything novel other than being the best, right? And so that's what people are looking for. And when they start to find that, that's when people see the opportunity to, come and capture that asset. And then, ultimately they will sell it off to, a bigger system or something like that. And so, that's what healthcare needs to look like now. That's what healthcare, that's what communities are wanting. And so that's been the fortunate situation that I've been in over the past few years. And so, I think that's where we have the real opportunity, because look, the stat deal that we are talking about, this Horizon deal, is, something that allows for a group of people to, be part of something that has materially change healthcare in the communities that it is in. And so this is a great part of the, our great addition to the portfolio. This is something that we can, create economies of scale on. And once again, I think that it just is a change agent for what healthcare needs to be as we go towards the future.
Fantastic. Perfect. And Brian, I'll end your question with this answer, a very practical answer, and just to give you some experience with this as well. I like to look at, before entering a business, I would like to know the exit, what that scenario would look like. Now, there are a few scenarios, three main ones that I have, or we have experience in personally. Number one scenario is a exit to a strategic buyer. That means that a big hospital that's trying to get into Texas, what do they need? They need patients. They would come into Texas, purchase a system like ours, because that would become a feeder system for their hospitals. Because patients, once they go to the emergency room, they need sometimes to be admitted at a hospital. They get patients through that. So it can become a satellite center for a lot of the hospital groups. It can be a new hospital group trying to come into Texas, or it can be an existing hospital group that's all over Texas already. They would be a strategic buyer. Do I think that would be the ideal buyer for this system? No, but we have sold to strategic buyers before. They can be beneficial if things work out. Secondly, there is a financial buyer, which means a bigger private equity firm, a public private equity firm, or some sort of a financial firm that is just looking for management teams and a steady cash flow business. Those, in our experience, have yielded the best return for our investors, because you have a self-running machine where it does not require Azhar Hirani to run that business. It doesn't require Jason Lesovich to run that business. It does not require Babar to run that business. We all can be replaced in that business, and someone else can come in and be plugged in, and that business will run itself. It's a very systems and process driven business. And you get that at an enterprise level. So having 30 plus locations, you become an enterprise level business at that point. So there are financial companies out there that are looking for businesses like these that pay the most top dollar. So the ideal exit would be that a financial buyer. Now, the third one is Bobber touched on it a little bit, but it is a dividend recap. So what happens is if you have a consistent business that's profitable, what you do is you look out 5 years from now, the dividends that you will be getting. You go out to banks and say that rather than giving a dividend to our investors, I want you to come in as a partner and cash out all the investors. It's like more of a cash out refinance. My investors will still be in the deal, and we de-risk the asset. Now the risk is on the bank side, and we still as investors participate in the future growth as well. So that is a third option that we can still go on and continue growing and creating value for the business. So now from going from 30 locations to now 60 locations or more, because remember, we're only in Texas now. There's so much opportunity in other states as well. Okay. So Brian, I hope that answers your question.
So if I can chime in, I just
Yeah,
want
of
to say, guys, I love the detailed answers. By the time we answer one question, we have 3 more that are asked.
Mhm.
So we've got to speed up the pace.
Let me speed it up.
Yeah, thank you.
Perfect. What are the risks in the deal? How do you plan to mitigate them? The risk in the deal is, let's say we buy it and the business that we looked at and had a history of patients coming in, possibly don't come in due to reputational risk or some sort of other risks that's out there. We've operated emergency rooms for the past. We got into the business. We started constructing on it in 2012, so about 12 years now. And we were the first movers in Texas. So pretty much a lot of the risks we've already dealt with in the beginning. So we're very well versed in the business in itself. So the risks are there as a business or as an investment, but we have a strong team to help mitigate that right away. What
Next
reporting and communications can investors expect throughout the investment period? Ramu, would you like to help answer that?
Absolutely. So at the very minimum, we'll be sharing a quarterly update to you guys. So whatever ZT Corporate passes on to us, we will then turn around and share it with you. TeamVelu will be your primary point of contact. And so all communication will come from them to us and then us to you guys. This is the exact same as all of our other investments. And the reason for that is because we could be your advocates to ZT Corporate. Let me put it in a very simple way. Let's say you invest $50,000 or $100,000 in a $75 million fund, of which they have 500 million in equity. Now they do have an excellent team. They will get to your questions, but it's going to come a little bit heavier when someone, hopefully knock on wood, we raise $3 million. We go in and we make a call. We're viewed as a much larger group or investor and get faster service. And that's just the nature of the world, right? So you guys get a benefit of going through us. We've also negotiated higher returns, so you'll be able to benefit in that as well. The communications will come at minimum once a quarter, if not more often, if there's any special news. And of course, tax documents will be handled by TeamVelu as well.
Fantastic. Chris Clover, how much is TeamVelu investing at this time? It's $3 million bucks.
Actually, I
what
think
commitment is?
Azhar, I think they're asking more of like us personally. So our family's investing 50,000 at this time. And the reason for that is because I'm buying a house in 3 weeks, my primary home. So that's what we can do right now. Probably more if it wasn't for that.
Fantastic. I can tell you Team ZT is investing us individually a lot of money yourselves, well into multi 7 figures. And that's actually some of the guys are just doing multi 7 figures themselves. So a lot of the team members are doing multi 6 figures or some of them 7 figures. So Team ZT ourselves are putting in a lot of money into this business, so we definitely believe in it. Is this for accredited investors only? I believe for TeamVelu investment team, they do offer up to 35 non-accredited investors. So I believe it's a combination.
If I can be very specific, 35 sophisticated investors up to, because that allows our sub-fund to remain accredited, and our sub-fund has to be accredited in order to invest in the main fund, EdCT Corp. So we've worked out the details on the back end. So if you have a question, if you're accredited or not, please reach out to me personally, directly, and I'll guide you through that. Here's the fun truth. Most people don't realize that they're accredited. So Chris, I know for you, you're accredited. You have no issue there.
Fantastic. The next question is, the pro forma slide showed significant revenue growth. How do you plan to accomplish that? Very good question. The thing is, we actually didn't even show a pro forma slide. It was the past performance that we have shown. We do not show any sort of growth in our pro forma. We've kept it the same business that they've done in the past. The next question is from Sammy. Is 25% dividend allocated for all 75 million or just 3 million to be raised by TeamVelu? So 25% is not the dividend. Actually, let me have Ramu help me answer that.
Yeah, basically, I'll take it, Ramu. So basically, as Ramu said, we have negotiated more for the sub-fund because we are investing more than $1 million. So that is being passed on to you. So definitely you are getting much more, and it is across the board for 75 million as well. It is not just 3 million. So you are getting a better deal. So that's the answer.
Anybody who's investing less than $1 million as an individual, or a sub-fund or anything, will not get the same returns that we're getting. They will get slightly lower returns. I say slightly, it's a few points per year. That adds up to quite a bit. So that's the direct answer. So they are paying similar returns for similar investments, same returns for the same investment in that $75 million fund.
Go ahead, Asher.
Perfect. So Chris is asking, please discuss what could go wrong with the investment. What can go wrong is we go in and there's a lot more problems than all the benefits that we saw when we were doing a lot of the due diligence. Just to note that we have gone through extensive due diligence, not only us personally, but also we utilize third parties to go in and do quality of earnings. Quality of earnings means the books that they show you, they basically verify that. And also if they show that, hey, patient A is getting $1,350 per patient, a third party goes and checks exactly what was that number. Was it 1,350 or was it 1,300 or was it 1,400? Also, we take a lot of seasonality out, like COVID patients or flus and things like that. A lot of the non-common stuff we don't include in the common stuff we do to get to our number within our model. Babar, Chihiro, Jason, would you guys like to add any risks that are involved in the business? Because I know you guys have met with the sellers and the sellers team. You guys have spent a lot of time there. You guys are very experienced in this business in itself.
There is a question, risks to the investment.
Yeah,
I think one that we haven't talked about that is potentially a risk is it's just competition, and the way I want to just address that because it's part of our underwriting and diligence process. We get a good feel of what that local market is like, and this is a very, very local business, right? ERs are people coming from a short radius, and I will say that risk is significantly mitigated by the fact, well, this area these areas are not major urban areas, so they're somewhat underserved. So we don't anticipate that being a big risk, and we also don't expect the local hospitals to be a big risk, because instead of being direct competitors, these facilities have transfer agreements with the hospitals, which enable sort of collaboration. So that's typically a risk in ERs, but I think that's very well mitigated on this deal.
Thank you.
So have you considered the current and future market interest rates, and how will it impact deals' future liquidity events? Barbara, I'm going to let you take that answer as well.
Sure. So we do look at interest rates. Obviously, current is important because we're financing part of the business, and that sort of has played into it. It is a historic or recently high rate environment, and the way we view it is, look, our facilities are floating rates, so as rates come down, they will adjust. The future rate environment also matters a lot. So, well, I can't predict where rates will go. I think we widely expect that they will start to come down over the course of the next 2 or 3 years, and as we get closer to the potential exit or liquidity event, a lower rate environment will help us. It'll no matter which path we go. So if it's a sale, it makes it easier for a buyer to finance. If we do a leverage recap, as we've been speaking about, that valuation is higher at lower rates.
Yeah, so been in the market for a very, very long time, 27 years. We've gone through all sorts of interest rates. We typically don't, since it's not like a real estate deal where it's very sensitive to that interest rate environment, it is a business at the end of the day. So the bigger, better marketing we do, the better team members we have, the more business we have. And it's a very high margin business. So there's a lot of room for interest rates can go as high as they would like. But as a business, we'll be able to sustain it, quite comfortably, because it is, it's one of those businesses where your cost is $600 and your revenue per patient is, $1,300-$1,400. So, Sammy is asking, what is the chance of dividend go lower or higher? We expect the distribution to be pretty consistent, because the business is pretty consistent. There can be a chance if it does go lower. Basically we'll continue giving that lower number, and then once we get higher revenues and things like that, we get caught up. Remember that as a firm, our incentive is actually to beat the numbers rather than, because that's how we get paid as a company. So our incentive is to make sure that not only are we providing the returns that we projected, but also beat that at the end. And our incentive is very much back-ended more than anything. So our goal is not to even just provide a dividend. We also want to make sure we have a liquidity event for the investors past the dividend amount that's projected.
So when I asked the similar question about interest rates and how it affects the deal to Chihiro, he sent me some data from the Fed. We reviewed that together. If you're curious a little bit more about this, please reach out to me. Happy to talk to you one-on-one about that data.
Fantastic. So the next question is from Tamarai. Can you explain more about your financial projections for the next 3 years, which could generate the expected return? Also, I could see the interest income and interest expenses. Can you brief more on that? Barbara, you want to take that one?
Sure. I don't think we shared projections in the presentation. That was historical data.
Historical data.
Correct me if I'm wrong. So the interest income and interest expenses in the historical period is how they have currently how the business has operated in the recent past. We are acquiring in the form of an asset acquisition, so those don't carry forward with us. We'll have interest expenses associated with the debt that will finance the acquisition, though.
Sounds good. And
So
in terms of go ahead, Raman.
In other words, you would have taken the current interest rate into consideration while you're underwriting, correct?
Oh, absolutely.
Yeah.
We stress tested quite a bit too. Remember, guys, we don't only stress tested, the banks stress tested too. So
another good thing what I have seen is you're only borrowing 50%, not over leverage, right? That's a great thing.
Yeah. No, we actually, ZT Corporate was born out of us, being brokers for banks. Actually, that was our business, to get financing for small businesses. So we know the banking world really well. At one point, another investment that we were in was a bank. So we were owners for about 3 years. We exited, got a very good return for our investors. So we understand banking very, very well. The next question is, how long did you take to liquidate / exit on ? So typically, before we have a projection of how long we want to hold it, so typically we would like to be at a 3 to 5 year range, with 4 being the sweet spot. The next question is, just curious, how does TeamVelu and ZT come together on this deal? How long have you known each other? So, Ramway, I would like you to answer this.
So we've known each other for a couple of months now. This is our first deal that we're partnering together on. Whenever we go through a new relationship, I mean, every deal has a start somewhere. So that's why we go and do the detailed, partner review. As you guys know, in our 10-step process of reviewing deals and deal sponsors, the very first step is reviewing the deal sponsor as individuals and then as a company. So before we ever touch the deal or talk about the deal, I think maybe came as a little bit of a surprise to Azhar and Chihiro. They kept wanting to talk about the deal. And I was like, actually, I don't want to talk about it for a couple of weeks. Tell me about your personal life, right? So kind of go in and really vet individuals and the company. So we've done our homework. I encourage you to do your due diligence as well. And it's every investor's responsibility to do their own due diligence.
Yeah.
But so far we've been able to put forward good quality performing deal sponsors, and we expect the same with our partnership with ZT Corporate.
Yeah, so just to add on to what Ramos said, it is about the culture of the organization. We really like them. And I hope the same thing that they like us too. And that is the most important thing in this kind of partnership, more than, the deal itself. And then, of course, those are important too, what they are doing. Thank you.
A good sponsor can make a bad deal work, but a bad sponsor can't make a good deal work, right? And so just a lot of the auxiliary support systems that ZT Corporate has gives me a lot of confidence that whether it's this deal or future deals, they have the cash reserves, the banking relationships, the expertise, and the people power to be able to overcome any hurdles that may arise in the industries that they're operating in.
Thank you very much. So the next question is, has any of your deals gone south? ? And why? So yes, we've gone. The most recent one was we had Carl's Jr. and Popeyes. We had 40 locations. COVID hit, and essentially there was no business at that time. And also, the corporate of Hardee's and Carl's Jr. was changing. So we basically decided to shut all the locations down. And for the and to protect the investors, what we ended up doing is we have management shares in other companies. So we basically ended up swapping our shares with our investors to where they took on our management shares and we gave up those shares. It was worth about 10 million bucks. Even though investors had only invested 8.1 million, now they have a chance for more upside. And also, there was a lot of debt on the deal. We actually ended up just writing a check. It was a little under 13 million bucks, where we wrote a check to the bank to write, basically just walk away from the deal. But we wanted to protect the investors, and we were able to do that. So that was the last deal that went south. Before that, we had a hospice in Dallas, where it didn't work out. It did okay for a bit, and then we had 9 hospices at that time. Dallas was one of the locations that wasn't working out well. So what we ended up doing is we met all the investors. It was not, it was just a few investors. We met with them, and we came up with the structure that we want to give their money back. They had invested with us, trusted us, and within 10 months, when 10 equal payments, we were able to pay them their principal. So at the end, investors ended up making about an 8% return on top of their money. So these 2 examples of the deals, the last 2 deals that went south, but out of 50 limited partnerships we've done, knock on wood, we've been batting at about 95% average, so pretty much, major majority of the deals, everything that we've done have hit projections, and a lot of them have exceeded it as well.
So this is one of my first questions to ZT Corporate: what deals went south, and why we, are still happy to partner with them is because they've never lost the equity of their investors. Now they're obviously, like Azhar said, there's been times where they didn't make returns, but ZT Corporate has stepped in the middle to ensure that investors get their principal back and preserve their reputation, which was one of the reasons, we want to partner with ZT Corporate. And to answer Mr. J. Raj's question, we do accept IRA investments. So you could do LLC, IRA, individual, joint, other forms of retirement accounts as well. So yeah, we welcome IRA funds.
Fantastic. I'm going to skip the high interest rate question as well. I think we've answered that.
Mhm.
And then the next question is, what are the fees to the investment? I might have missed. Is there any
No,
upfront
this one
fee
is like,
percentage?
yeah, it's like we are doing 85-15 in the sub fund, right? So for that, we have negotiated, because we are coming in as $1 million investor, we get extra percentage from there we are taking actually.
So unlike
in fact,
a
yeah,
unlike a venture capital fund, you guys don't owe any fees on your investment.
yes,
In fact, 100% of your money is going into the fund with ZT. We're not taking anything at the sub fund level either, from your investment.
yeah. Actually,
And
actually, $25,000 is going to be set aside for legal, accounting, and to run this sub fund. So supposing if we raise $3 million, less $25,000 will be invested with ZT. So that is there in the PPM. All right.
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 And then any returns are 15%, 85% split, favoring the investor.
Fantastic. So, Andrew has a question. What towns are the 3 micro hospitals and emergency rooms in? We have a very strong NDA, so we can't reveal the towns we're in. But what we can tell you is, these are close to the like, how do I say this without actually giving away? It's more border towns, essentially. And consistent with strong insurance, in those areas as well.
And high population growth towns as well.
Yeah.
Let's go through these questions pretty quickly for 5-10 minutes, and then we'll take those other questions through email and answer them as well. Go ahead, Ashad.
Okay. What are the conditions you have in place to declare this project working or not working? What are the conditions you have in place to declare this project working or not working? I'm so sorry. I did not understand
I
that.
think we already talked about the risks and all that.
Okay.
And so that should cover, but basically, since it's already working project only you're getting, and except your operating cost could be a little bit more or whatever it is, otherwise it is already working. And it is the revenue that is going to decide whether it's working or not, right? So,
Revenue will, but technically operating costs should go down because of economies of scale. They already have 3 other hospital groups that they're running, or sorry, 4. So it should just, the back end system should merge. That's actually where a lot of the profit extra growth is coming from, because they're not assuming any top line profit growth. It's got to come from somewhere, right? It's the back end savings through integration.
thank you, Rama. That's a value add. Yeah, go ahead, Ashad.
We're almost done, guys. Sorry. I know we've kept the ZT team on pretty long. I think they actually had an executive meeting. So we'll answer these
Jason's just
questions.
downstairs at his offices, so we're used to working late. So, but the next question is, how many times have you done that ? Is there a communication guarantee? Who were the third parties? I don't understand any of these questions except
Okay, the third party is what, like a due diligence, you said,
Oh.
the $1,250, $1,300 and all that you said, right? That's what they're asking.
Yes. Yeah. So it's a quality of earnings company. Whenever you acquire a business, or when you sell a business, you usually do a buy side quality of earnings and a sell side quality of earnings. This is a good way to independently check the numbers. The company that we use is an expert at emergency rooms, and that's all they do, or they specialize as a subsector for that. We've used them before, and they've done great quality work. Because in healthcare, it's not just, one patient comes in and you get $350. You have to bill the same patient, 20 different ways for $10 a day, $20 a day. And it's like a series of days that you basically bill for these patients. So it's very complicated. So they decipher that in the quality of earnings with their expertise.
And the communication, do you guys send a monthly report or a quarterly report?
No, so every time we declare a dividend, there'll be a quarterly kind of like a just an announcement that we're declaring a dividend. And then if there's anything materially changing in the business, then we announce it. If not, once a year we do a letter. Jason writes a letter to the shareholders, telling exactly the things that we did or we do. There's not a lot of competitors in this business. That means that it's highly competitive within those owners. So we try not to give our secret sauces away, in order to keep winning.
Yeah,
So
so
in terms of
probably we
updates
cannot get
with
too
the-
many details, yeah.
With the dividends on a quarterly basis, they will
Yes.
be sharing updates.
Yeah,
with
it's
you.
automated through our system.
Yeah,
And
yeah,
then their annual report we'll be sharing with you.
Yeah,
Chris,
we do a.
they're saying the answer
we
is no. That's technically guaranteeing a communication is not possible. We can promise a communication,
but
right?
yeah, another thing what Ashar said is like unlike the apartment investment where we will say that, oh, we repaired this, we did that, we will kind of report every operational detail. Probably for business reasons, they won't be doing that as well. That's what I heard.
The
And,
annual
thank you.
letter will describe a lot of those updates and performance.
Whatever is
Yes.
But
possible.
by the way, Chris, and for everyone else who's watching, I do want to say that if you independently or individually have a question at any time, quarterly or not, reach out to me and I will get you an answer.
Yeah.
So it's not you just have to deal with whatever we give you. It's just we will share. But at any point for any of your investments through TeamVelu, if you have a question, please text me, email me, call me. I will make sure to get your answer in a satisfactory manner to you in a timely fashion.
So Chris, probably you have to stop your questions and we will meet with you later and in case you need, and I will try to answer a couple of your questions. How many times have you done that? I think if you're asking about these investments, they have got more than 15 years and we also have over 7 years of experience and we have done multiple deals. And
we've done about 25 deals. They've done about 50.
And why 4 years? Actually, they say that they're saying that 3 years to 4 years, which means anytime, like it is, they're looking for exit, correct opportunity, and Babar already, I think he addressed it. And there is no fees to you. It has already been addressed in this. And the recording of this will also be shared to you guys in case if you want to listen again.
Final questions, and then we're almost done.
And how do you address physician and staff attrition after acquisition? Sure.
Very good question. I'll have Jason take a quick answer at that because we've actually been working on this for a very long time. So, Jason, you're on mute. Yeah.
All right. So could you tell me that question again?
Yeah. So how do you address physicians and staff attrition after acquisition? That basically we had this. We had a board meeting, guys, today. We had an executive meeting. This was the topic we had just discussed of retention of physicians.
Look, I think, yeah, sorry, I didn't mean to interrupt you, but look, I think this is one of the most important things, right? These people have come together and built a business in this community, and they're known in that community. And so when we go in there, we're not going in to redevelop a business, right? We're not rebuilding the bicycle. What we're doing is we're taking a business that's already super successful and we're building in our economies of scale, building in the things that we know that we can help the business with. And part of that is bringing that management group and that ownership group along. And so, with the group that we have right now, one of the things that, Babar and I asked as soon as we got there was, are you planning on being a part of this? And they said, yes, we're going to be a part of it. We're going to help you because these guys have built a legacy here. These are 10-year-old businesses that they want to see, continue to change the community. And so, look, we're not interested in going in and starting from scratch. And so as we look at management teams and as we look at ownership teams, we want to make sure that those are going to be our partners going forward. And so we lock them down. I mean, we create incentive packages for them. And we also, recognize that they are important to the business. And that truly does create that partnership that really excels that business into what we see it can be. And so when we bring, you know, our management skills and our platforms and our systems and our economies of scale, because we have a portfolio, and then we also have that, you know, engagement in the community, it truly creates a spark that, you know, that we capitalize on. And it's a good thing for the community. It's a good thing for the owners. It's a good thing for us. And look, I mean, you know, you have to remember that in healthcare, a lot of people only think about, like, when you think about the groups that you are serving, right? They think about the communities that they're serving, the employees they're serving, and that's where they end up. The most important of all of the people you're, you know, trying to engage and be a part and serve is the stakeholders, because without money, there is no mission, right? And so if we're going to grow a business, if we're going to grow, you know, how we see this thing going and changing healthcare, because it's about being shepherd servants. I want to make sure that we understand that. And that's how we're different, right? And so I think that, like, what people don't understand is if you lean in and serve first, the money comes. And that's how we've been more successful than others. And so,
Beautiful answer. Beautiful,
anyway,
beautiful.
thank you.
Yeah, so we are not, you know, like, we are treating them as partners and asking the right question and supporting them with what they need and treating them well and then growing the business. Beautiful. And so I think we have come to an end, and all the rest of the questions we can answer through email as well. But the last two questions are, what are the conditions you have in place to declare this project success or failure? Success, you know, we have already talked about all the successes they have made, how did they exit, and finally it is about the money what they produce. And success, you know, sometimes what they said is, hey, they expected only 20% return, sometimes they were able to produce 30, 35, and they always exceeded their expectation. If you know, if that is a good news from them so far. And economies of scale, yeah, Ramu.
Yeah, sorry, I didn't realize I was on mute. So economies of scale, I'll start the answer off, and then Azhar and team, you guys can finish. So while I was walking through the office, I was like, what does this team do? What does that team do? And Azhar was like, this is our credit card processing team. And what they shared with me is, hey, when you have a $1.2 billion business, your 1% credit card processing fee adds up to be quite a bit. So they do their own credit card processing. We walked through a floor that looked like a bunch of cubicles, people on the phones. Hey, what does this team do? And they said they're the medical billing team to maximize billings from our insurance companies, from the insurance companies to the micro hospitals. So those are two examples of integrations that they do. Azhar, what other integrations and economies of scale does ZT Corporate offer for the
Beautiful,
health?
Ramu.
Absolutely. So I can go so many. Just quickly, you know, in each facility, usually when you walk into, you know, because a lot of some of the facilities are closer to each other, we can have their facility directors shared between, you know, multiple facilities. We have regional directors that are shared, so oversight becomes a lot easier. A lot of it is our accounting is very efficient just because of being such a large company. Payroll and things like that, benefits are very smooth. HR teams are shared between all the companies across the board. Our accounting teams, you know, so because we have such large systems, we get a better rate on our accounting overall. Also, just now, and I'm kind of paraphrasing from today's board meeting that we had. You know, we're having our own supply chain now, so group purchasing is a lot cheaper. Also, you know, having affording a lot of the physicians, because there's limited amount of ER physicians that work in the state. We can get them at a very competitive rate compared to others, because now they have consistent shifts that they may not have at other places. The benefits that they get with us, you know, they have an option for 1099, W-2, or just doing locums. So there's, you know, options there. Also for folks that are working, they're people, we have, I kid you not, the amount of people that want to work, you know, with us. So we get quality folks at a very competitive rate. because they see that growth that they can kind of build into in the future. So I mean, I can go on and on and on. But the economies of scale is in every aspect of the things that we do. Also, we were one of the first companies that got vaccines. We were the first. Like, I think we had a 99% rate of vaccination within our own firm. We were the first company to get it. I mean, City of Houston actually came to us and said, "Hey, can we share in this? Can we send some of our City of Houston employees to get vaccinated at your place?" So it's an incredibly efficient system that we run. So knock on wood.
Azar, thank you so much, and thank you to the whole ZT corporate team for staying on and answering questions for a whole hour, maybe even more. I think we're going to split the recordings between the presentation and the Q&A. Guys, this was awesome. Azar, thank you for coming on. Jason, Babar, Kevin, Chihiro, I really appreciate your time. And to our investors and those who are watching this webinar right now, thank you all for coming, staying an extra hour that you probably didn't plan on staying for. It's close to midnight for some of y'all, depending on your time zone. So really appreciate everybody's commitment. Once again, please reach out. My cell number is 972-754-7943. Text me. Let's find a time to chat, and let's get this moving. 20% of our deal is already subscribed. Like Dad said, we do anticipate the 3 million to be oversubscribed. We look forward to discussing this further and seeing if it's a right fit for you. Have a good night, everybody.
Yep. Once again, thank you all very much. You guys, ZT team, you guys provided quality answers. We really liked it. Appreciate you and really looking forward to our partnership. Good night, everybody. Thank you.
Thank you, TeamVelu.
Thank you.